Our lesson for today will be about sources and uses of short-term and long-term funds. The role of the VP for Finance Financial Manager is to determine the appropriate capital structure of the company. Capital structure refers to how much of your total assets has financed by debt and how much has financed by equity. Financing decision. Debt financing. Form of borrowing, whether short-term or long-term, and it usually comes with interest. Common debt financing arrangements include bank loans, issuance of debt instruments like bonds, financing from non-bank institutions like lending companies and cooperatives, assignment of accounts receivable, and selling of notes receivables. There exists a borrower-lender relationship. In case of banks and other non-bank institutions, borrowing entails compliance of certain requirements. Disadvantage of debt financing. It creates obligation for the borrower to pay the interest and the principal. In case payments have not made, interest and principal leads to penalties and more interest. Benefits of debt financing. Interest expense is tax deductible. Allows the company to grow without diluting or reducing the interest of the controlling stockholders. Creditors generally do not intervene in the decisions of the management. Equity financing. This is also called internally generated funds. It refers to issuance of new shares of stocks and retained earning plowed back into the operations of the company. There exists a borrower-lender relationship. Benefits of debt financing. Does not require mandatory payment of dividends. Provides the company flexibility. The company is 100% financed by equity, or its leverage ratio is very low, so it can attract creditors. Disadvantage of debt financing. Cash dividends are not tax deductible. Offering new shares to other investors may dilute the ownership stake in terms of percentage of the existing stockholders. Most expensive source of financing. In pecking order hypothesis, this is how companies fund their requirements based on repeated observations. Companies' funds comes from the internally generated funds or operating cash flows. Debt financing is the next alternative if the internally generated funds have been exhausted. The last priority is the equity financing. Since it is more difficult to issue new shares of stocks, sources and uses of short-term funds. Used to finance the day-to-day operations of the company. It is used for working capital requirements and bridge financing where a company has some maturing obligations. The following can be sources of short-term funds. Suppliers' credit. Suppliers of raw materials and merchandise are the best sources of short-term working capital. Advances from stockholders. Personal funds advanced by a stockholder to a company that usually requires interest. Credit cooperatives. Provided lending services to its members. Members usually pay contributions to the cooperative. Bank loans. Provides several loan products catering to different types of needs. Lending companies. They usually charge higher interest than banks, but their credit requirements are more lenient compared to banks. Informal lending sources, 5 to 6, very expensive source of financing, and should be avoided. Sources and uses of long-term funds. This fund is sometimes called capital investment. This is used for long-term investments that include expansion, buying new equipment, or buying a piece of land as site for future expansion. The following can be sources of long-term funds. Equity investors can be issued common stocks. This source of funds is the most patient and safest source of capital, but not always available when company needs it. Internally generated funds. Not all profits are distributed to stockholders. Most of the profits are reinvested and used by companies to finance their needs. Banks. Provides long-term loans depending on the nature of need. Bond market. These are debt investments where an investor loans money to an entity which borrows the funds. This market is gaining more popularity among our big publicly listed companies for their fundraising activities. Lending companies. Also provides long-term loans and can process faster, but they charge higher interest rates. Banks and non-bank institution. Banks. Financial establishments where money deposited by customers earns interest and can be withdrawn anytime when ordered by the signatories. To be able to pay for the interest for the money entrusted by depositors, a bank invests it to financial instruments or extends loans to borrowers. Non-banks financial institutions. NBFI. can provide fund requirements of business. Their operations are not supervised by national or international banking regulatory agency, or no full bank license.
Loans and its requirements. Personal loan. This is a type of loan from banks that may or may not require any form of collateral as security of payment. Sometimes called character loan. Grant loan based on the deposits of the borrowers either equal or less than their deposits, as an example of any form of collateral. Must be at least 21 years of age or older. Must have an annual income. Must have landline or post-paid mobile phone under the account of the borrower. Must have at least 2 valid identification card issued by government or employer. Personal loans interest rates and fees. Interest rates depends on the bank or financial institutions you apply with. Personal loans charges and payments. Offers flexible terms to attract more borrowers, but subject with what will be agreed upon by both parties. Housing loan. This loan granted to homeowners and individuals who want to have their own homes, but do not have enough savings or liquid funds to make immediate purchases or other improvements. This can be availed either for buying a real estate for dwelling purposes or for house construction or renovation purposes. It can also be used for refinancing an existing housing loan. It can be paid on an installment basis, thus easier for making home ownership. This type of loan involves large sum of money, which needs a form of payment security. Thus, banks hold the mortgage property as collateral until payments are full paid. Must be a Filipino citizens. For foreigners, must submit acceptable visa like working visa issued by embassy officials, quota/non-quota immigrant visa, or SEC 13A visa. At least 21 years old, but not older than 65 years old upon loan maturity. Must have a minimum monthly salary of P50,000. Must have a source of income, employment, or business. For employed applicant, must be a regular employee with at least 2 years of tenure. For self-employed, must own business for at least 2 years of successful and profitable operation. Auto loan. Allows an individual to buy a vehicle that is more expensive than what could be afforded in a lump sum or cash purchase. Individuals can acquire at more affordable payment terms, usually in an installment basis either through in-house financing offered by car dealers, or financial institutions like banks. Approval of auto loan is easy if the potential buyer has a proof of good credit score from a bank or preferred financial institutions. Completely filled auto loan application form. Photocopy of any valid ID. For employed applicant, photocopy of latest ITR or income tax return, original certificate of employment, and 2 months pay slip. For self-employed applicant, validated photocopy of business registration from DTI or SEC, audited 2 years financial statements, and photocopy of latest ITR with the IR stamp. Obligations of entrepreneurs to creditors. Entrepreneurs who borrow funds to be used in the operations of the business and purchased products or services on credit are bonded to fulfill their obligations, which can be classified as follows. General, obligation based on moral duty that ties 2 or more parties together. Accounting, duty to make future payment when purposes order is placed. Legal, liability or duty based on what is agreed upon, like the provisions or terms as stated in a contract. Specifically, the duties of a borrower to its creditors. 1. Pay the creditors based on the payment schedule agreed upon. 2. Provide the collaterals as agreed upon in the loan negotiation with proper documentation, if necessary and applicable. 3. Comply with the provisions of the loan covenant, such as maintaining certain liquidity and leverage ratios. 4. Notify the creditor if the company is acquiring another company or the company is now the subject of acquisition. 5. Do not default on the loans as much as possible.